Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, another update video choosing the biggest position, biggest single individual position in the publicly accessible portfolio, which is the Crassus investment portfolio on eToro. So we're going to be talking about Petrobras today, guys. We have the preferred shares, the A shares, and we're going to be talking about their recent announcements and why I'm so bullish on the company, entering into a commodity super cycle right at the time where you can buy one of the best collection of assets in the world for extremely cheap valuation. So straight into it, disclaimer, I am not a financial advisor. I do not know your circumstances. Nothing I say here is to be construed or taken as advice. It is simply my opinion, what I may be doing. It may be right, it may be wrong. And just because it's what I'm doing doesn't necessarily mean it's any good for you. So having said that, please always do your due diligence and seek a professional advisor before making an investment decision. And that is not myself. I want to mention ways that I'm leveraging this particular company. Petrobras have several option strategy that is really squeezing the juice out of an already juicy income play. My Substack private group is called the Options Mavericks, and I generate income by selling options over publicly traded stocks. Currently doing nicely this year, about 6.5% per month on a monthly basis have been the returns. So that's quite good, and an income orientated fund. Last year, annualized returns of 25.85. And in this Substack, you get a free trial. I share everything with you, the trades that I'm doing, and I have an ongoing tracking system of the trades that are recommended, and therefore you can see exactly what their outcomes have been. So details are in the link below. 7-day free trial, typical Substack stuff, guys. Check it out. I know you're going to love it, especially considering a lot of the plays that I do are regarding Petrobras at the moment. So an investment formula, something for a little bit longer term. I'm looking for low debt with a margin of safety, sales growth, strong margins, free cash flow growth, and ideally share buybacks if available, or some sort of shareholder return program. That's a Crassus investment formula. Little recap, if you're new to the channel, I'm bullish on oil and I'm bullish on Brazil. There are some drivers of this investment thesis, and we're going to check in and see how those are or are not playing out. Stronger oil prices is obviously one. If you're an oil company, you want decent oil prices in order to maintain revenues above costs. Petrobras, the A shares, have a very low lifting price, just over $20, and they're at an absurdly cheap valuation. Okay, so if I'm wrong or I'm early on the thesis of the commodity itself really taking off to the upside, oil could chop sideways for many years in this current range between $7 and $80, and this company is churning out free cash flow like a machine. So it gives me a little bit more flexibility in that aspect. Obviously, then you have equity risk. Stronger investment flows into emerging markets is something that I've already been seeing in different sectors, not so much in the energy space, but I believe it will be coming, particularly in Brazil. And I think that this will raise some of the multiples that we've seen. These stocks are just trading at dirt cheap multiples. And by multiples, I mean how much over the amount of profit that the market is willing to pay. So for every dollar of profit, how many dollars is the market willing to pay? In North American stocks in the S&P 500, it's still, I believe, over 20 at the moment for every dollar of earnings, where you can buy one of the best collection of assets in the world. And depending on your metric, you can buy it for barely $2 per dollar of earnings. And we're going to talk about that today. Recently announced dividends. Everyone was super happy in the Fin Twitter sphere, including myself. 30% yield plus potential buybacks may also be coming in a new shareholder return program at the end of the year. We'll see about that. More production is coming online, and that, of course, could increase the revenues and provide the company with more free cash, with which they can repurchase shares. They can dish out more dividends. It's all gravy as far as that's concerned. So tenet one of the thesis, we talked about oil prices. So let's take a look at oil prices over a yearly period, 365-day period. We're looking at Brent oil here, and then the crude month at the bottom. So both are down over 30%, and it's biased a little bit by the fact that there was a war initiated, I believe, February 24th in 2022. And so oil prices shot up on that news. We're chopping sideways now at around about $70-ish, although it picked up recently today. And as I mentioned, this is key because, okay, oil just oil just has to do okay. It doesn't have to really take off to the upside, although I do expect that it will. In the second half of this year, I expect to see some real pressure on the supply side for oil, Chinese reopening. But I've spoken about that a lot. I've spoken about that in my interviews with Josh Young and Shubham Garg. So I won't recap. Go and watch those interviews on the channel. They explain it extremely well. In this price environment, the company, Petrobras, continues to do extremely well. Okay. If we look at the second tenet of the thesis of capital flows moving into emerging markets, if we're looking at the Brazilian government bond versus the US 10-year, the Brazilian, and this is price, not yield. So the prices have actually outperformed, meaning it's more desirable, relatively speaking, over the last year for people to move their money into Brazilian 10 years as opposed to US 10 years. In the US, we have an inverted yield curve where the Fed is raising rates at the front end, but investors don't really believe they'll be able to continue doing that. And that's why the yields on the 10-year have just kind of stayed a lot flatter. So the short part of the curve is high in terms of yield. The latter part of the curve has stayed relatively flat to low, meaning the market, the bond market at least, is expecting Jerome Powell and the Fed to reverse course at some stage or put a pause under these interest rates. In Brazil, however, you're getting a decent move into that capital markets. Okay, so the spreads have actually been at their lowest in about a year. Okay, so let's take a look at some of the key aspects of the financial reporting. We won't make your eyes glaze over. But if we look at Q1 2023, you can look at the foreign gains of the real versus the USD, and they've been less than what they were in terms of gains last year. So as well as the company did, if we expect the real to continue to strengthen, if and when this Fed pause or pivot occurs, it's another source of revenue for the company. If we look at average Brent prices, and that they were able to establish about $81.27. Okay, so $81.27. If we look at the total production or lifting cost, we're going to call it $21. Okay, so that's obviously a very low cost producer for South America. And why I've highlighted this on the left, you've seen my thesis in previous videos around offshore, and it's getting harder and harder to find onshore reservoirs at economic developments in certain parts of the world. So I believe that more and more capital will flow into the offshore space. This is one company that looks like they're willing to do it. So it's very interesting to see that deep and ultra deep post salt rigs pulling up at around about, call it $13 to get the oil. So I think if we get into an oil price environment, well above $80 in the future, more and more capex is going to flow into these guys. Gas and power. What do I need to say here? They got decent, I suppose they got decent gas prices considering where gas has been over the first quarter of the year. Not much else really to say about that. Trading about $73 a barrel. Last year, you remember that the TTFs hit, I think, over $350 per barrel of oil equivalent, which was pretty crazy. And yeah, so they're continuing to make some money through gas and power. Their debt is coming down, so this is good. They seem to be making prudent use of the capital, the free cash flows, bringing down the debt quarter on or like for like year on year quarter and quarter on quarter, and it's come down by nearly 10%. So yeah, their debt ratios look very, very good. Net debt adjusting for EBITDA less than 1. I mean, that's very, very good. Average interest rate is less than 7. And then the weighted maturity of their outstanding liabilities is out over 12 years. So they should be able to manage that quite successfully, I would imagine, with the cash flows they've been able to generate. Then what else needs to be said? Net debt plus market cap minus leverage is not particularly interesting. Yeah, I think that all things are looking pretty good. Let's take a look at the multiples that I mentioned. So looking at free cash flow, I mean, it's just crazy where some of you're paying over the last few years, the last year, $2 per dollar of EBITDA, $2.90 per dollar of free cash flow. I mean, that's an insane yield for a major mega cap company. And so if we would expect that to get close to 10-year means, you'd almost be looking to double both those metrics. So if I'm looking at now our back of the envelope valuation, it's not barrel of oil equivalents, back of envelope valuation for 2024, the current price of $10.43. On a per share basis, so free cash flow per share, I'm just using the analyst expectations, and I think that might actually surprise on the upside because this company has a lot of new developments coming online, and I think that could add billions of dollars worth of more revenue per quarter, and it might surprise on the upside. In any case, we'll be conservative. $5.20 free cash and $4.15 of EBITDA. I've assigned a 3 times multiple to that free cash flow, which is ridiculously cheap. And same sort of deal with EV to EBITDA, just using the kind of the 10-year median. You obviously can do your own due diligence there and put in whichever valuation metrics you like. But the way that I look at this is, look, whilst people are somehow willing to pay 20 times earnings for the broad market, right at the point where I think those earnings are actually going to start to contract, you've got an industry that is set to grow that is already trading extremely cheaply on 30% plus free cash flow yields, and this particular company is giving a lot of that cash back via dividends. So very interesting. Implied prices would be here. Equally weighted average is looking at around $17.76 would be a rough valuation of those cash flows and EBITDA, which at the current price suggests about a 60% upside from here over the year, which would be very, very, very nice indeed. And a little bit harder to do a longer term analysis in this particular fashion, this DCF style fashion for a cyclical business. And there's obviously more uncertainty the more time you take into it. What you can do is increase either the discount rate, or you can be extremely conservative with your assumptions. And I've done both. The discount rate here, this is a Brazilian company. What I've done is use the method suggested by, I guess, the professor of valuation, Aswath Damodaran, looking at the weighted average cost of capital plus spreads over Brazilian bonds and US government bonds. So that's where I get that from. And you can use whichever discount rate that you like, but I think that makes the most sense to account for currency risk. Growth has been very conservative in my opinion here with the assumptions, and the terminal multiples we've already spoken about. I've assigned a base, a bull, and a bear case. And this is where the art of investing comes in. The actuarial part is a science. This is the art. I think that this is on the conservative side, consistent with what our back of the envelope calculation suggests at about $17. Here we've got an average intrinsic value of $19 for these cash flows. And if you want to apply a 2/3 margin of safety to that, $12.56 would be an entry price in the green at the moment, trading at $10.50. So that's a recap, guys. That's where we're at. The company continues to increase the CapEx, continues to increase capital returns. And in a world where we need more and more oil, more and more energy, this is one company that actually looks like they're going to be able to deliver that in, of all places, emerging markets. So there you go. I think that the ability to purchase this company, the political risk has been priced in. Lula already has surprised people with some of his appointments. They seem to be fairly sensible. The last time he was in office, this company did very well. The reasons that I've mentioned in the past, Brazilian Senate seems to be fairly gridlocked. It's not a dictatorship like most people think. And I think in Brazil that would just be too difficult to achieve. The people wouldn't have a bar of it. As far as I can tell, I'm not saying there's no risk. Of course, there's risk and political risk in Latin America. But I mean, this is a collection of some of the finest assets in the world in the sector that I like most right now. And I can buy it cheaper than anything else. So that's my rationale. That's what I'm doing. I'm already fully allocated. It's my largest publicly viewed position. It's not my largest position. But in terms of what people in the public portfolio can see, this is my largest individual position. It's the national gem of an entire nation, cheapest oil major on earth, right at the time where it's the dawn of a commodity bull market, in my opinion. and they seem to be committed to shareholder returns with an extremely high return on equity. So that's why I own Petrobras. I'll continue to play it. I'll be reinvesting the dividends, and I'll be trading the hell out of the options market for this particular company. If you want to learn more about that, trade it at a faster pace, either gain some more income or get leverage upside exposure. I'll show you ways that I am positioning myself for that very thing. And other than that, do your own due diligence, guys. I hope you're all well, and I look forward to catching up with you in another video. Like and subscribe to the channel, and do leave your comments in the comment section. Cheers.